Hello and welcome to Energetic Incorporated, episode 4. This week I'm going to give you a rundown of my sort of how I developed my big picture view and where I see things going forward, how things are going to play out in these crazy times. So there's a very strong narrative being put forward today about the U.S. being ripped off by the rest of the world. That the trade deficit and trade practices of other countries is unfair, that it's a scam, that it's gone on for too long, that the U.S. now wants to see the trade deficit go away. I think it's important that we pause to have a look at a little bit of history so that we understand, how we got to where we are today. Banking started because people didn't want to keep their savings under their mattress because they would be robbed, right? And so we started saying, let's put whether it's gold and silver coins or whatever, let's store them in a bank so they're safe, and let's just exchange papers so that we can, we'll settle up later with the actual physical gold and silver, but we're going to use these paper credits, and that way we can prevent theft. At first, when we started using paper, it was 100% backed, right? We would lynch bankers if they created more paper than they had gold in the vault, right? These promissory notes, these gold notes from different banks were issued and used the same as gold. And inevitably, bankers and bullion banks or different banks decided that they wanted to create more paper than they had gold or silver. And that they found that it was very profitable to do so because they could then earn the interest from the fractional reserve system that they were creating rather than paying savers to lend. The fractional reserve system kept evolving over time, and there's been numerous failures over the centuries. So they created the Federal Reserve System. It was put into place in 1913 in the USA. And this was supposed to be to prevent runs on banks and provide this support system so that banks could do what they wanted to do, which was the very profitable fractional reserve system. The banks wanted to be able to create more money than they had in reserves, in gold reserves, and be able to lend it in the economy, and we ended up with this massive boom, the Roaring 20s. So after the Roaring 20s, we had this deflationary collapse because of overlending, bad credit, bad loans, runs on banks, bank failures all over the USA. And during the Great Depression, in order to put a stop to the runs on the banks, they had to break the tie of the US dollar to gold. And this was 1933, executive order. Franklin Roosevelt broke the promise of gold's convertibility. And immediately after this promise was broken, it was originally $20.67 per ounce that it was convertible. After this promise was broken, they revalued gold to $35 an ounce, but they said it's only convertible for foreign central banks. So in the years that followed this break and promise to their citizens, the USA continued to create money and spend it abroad, with foreign central banks accumulating US dollars with the belief that they could convert it to gold at any time if they chose. But the deficits began to grow in such that some foreign central banks were stepping up and saying, we want to convert and we want gold. We want gold for our US dollars that we've accumulated, our bonds that they had been purchasing. And in 1971, in August 15th of 1971, Richard Nixon broke the tie of the US dollar to gold. Broken promise, major broken promise to the rest of the world. And the US dollar, you remember, was the reserve currency. It had been the reserve currency. These nations had been accumulating it, believing that it was convertible to gold at any time. So following the complete abandonment of the US dollar being tied to gold, the gold price went up from $35 an ounce to $850 an ounce, or about 23-fold between 1971 and 1980. Silver went from $1.50 to about $50, which was a rise of around 31 times. When you start engaging in a fractional reserve system, it creates inflation, and so prices go up. So over this same period of time in the 70s, what did we see happen? We saw groceries go up by 100%. House prices went up by 150%. Wages went up by only 90%. Price of a car went up typically 100%. So it wasn't just that gold and silver ran, it was the price of everything went up. It was strong inflation. Most bull markets end in bubbles. And the 70s bull market in commodities and gold and silver was no different. Gold and silver got overvalued and eventually broke, with gold falling 70%, silver falling over 90%. Confidence was restored in the US dollar as a result of gold and silver falling. It gained in value. And that price action itself of seeing gold and silver falling relative to bonds that were providing a high yield interest rate return made them attractive. Foreign central governments laid off buying of gold and silver, and a new era began. And from then forward, the U.S. was able to run twin deficits, both budget deficits, government deficit as a percent of GDP, and they were able to run deficits in their trade deficit as well. So we'll pull up the chart here of government deficit as a percent of GDP and look what sort of followed in that period. So if you look at from the 1980s to the mid 1990s, the U.S. was able to run a significant, but not huge, but still very significant deficit to GDP, meaning that they were spending, right, creating money through the issuance of bonds by the U.S. Treasury, being supported by bank buying in order to fund government expenditures, until it started to actually drop off in the late 90s. And that was when we had in a booming economy. This was running along, and there was concerns about the debt, but they began to dissipate in the late 90s as we saw a speculative market run in all the major indices, especially in the NASDAQ, leading up to the year 2000. Good corporate profitability, taxes getting paid, and then the surplus peaked around 2000. If you had the view I had at the time, we were in a stock market bubble, and I was anticipating that the bubble was going to burst, capital gains were going to evaporate. What ended up happening was this was the peak of the bull market in most equities. The NASDAQ bubble burst. Corporate profitability declined, especially for tech companies. There was a massive drop in tax revenue, an increase in unemployment, so increased entitlement payments. And all of a sudden, we flip back into a major deficit position. Starting in probably 2001, end of 2001, we're back into a deficit, and then spike quickly upwards into a near record level deficit. We then had a boom in the economy again, leading up to the 2008 financial crisis, when that market broke. And we saw, again, in order to prevent a deflationary collapse, to prevent a meltdown of the banks, we saw this massive government deficit spending and bailouts in order to save the market. And the deficit spending as a percentage of GDP spiked out of control up to 8%. And again, this was another signal to the market that the Federal Reserve will step in and prevent banks from failing and print whatever's necessary, monetize debts, whatever's required, inject capital, quantitative ease, that's where that term came about. And this capital flows overseas to fund the purchase of goods and creates the trade imbalance that we've seen. Wouldn't it be great to be able to just be in a position where you could create money out of thin air and spend it around the world? It's hard to fathom the sheer size of this historic trade deficit. The volume of goods is just, it's unbelievable. And I look at it and say, what an amazing, if anyone's been ripped off, it's all the people who have been working their fingers to the bone, producing this stuff, and in exchange, they've received paper. The whole reason why foreigners should hold on to government bonds is that they're going to be paid back with work, with taxes. And if you're going to just print it, right, and buy the bonds, if you're just going to say, here you go, thanks for holding these bonds, here's some cash I'm just printing you, and settle up this bond debt with freshly printed cash, most reasonable people around the world should be rather uncomfortable with that, because they're gonna then say, well, how much yield am I getting? It's a fairly small yield, right? Today they're between 4 or 5% or whatever for most bonds. What's my purchasing power going to look like a few years out? Am I going to be able to? Am I better off waiting for this printing and waiting for this new money creation, and then trying to buy things? Or should I just be cashing out now and getting a claim on something? Because when we look at this government deficit as a percent of GDP, it's still running out of control. And GDP has grown as well. And when you start looking at it in nominal terms, you can see how ridiculously unsustainable it is. And so now we're looking at, how is this going to play out? How are we going to unwind this situation? Because it's clear that the Trump administration no longer wants to have things continue as they have been. And so any way you slice it, if trade is going to be settled up, you're going to have to imagine that means that the printing press alone is not going to allow you to buy goods, which means you're going to have to work more, right? You're going to have to work more producing stuff in order to get the stuff you're getting, right? Because foreigners are not just willing to park the proceeds from their sales in US dollars. They have to spend them. And it's not going to be finished goods. I mean, the differential in costs between finished goods in the USA and most finished goods in China is several fold. Foreigners typically looking to buy things from the US that are very energy intensive. They're going to take advantage of the fact that the US energy costs aren't that significantly high compared to other parts of the world. And this is at a time that the US is basically saying, well, we're going to have to increase production for ourselves. If you want to actually have domestic production, you're not going to ship all these different individual pieces and just assemble it in the US. You have to have from the ground up, meaning produce the steel, produce the energy, produce the raw materials, produce the rare earths, produce the silicone, produce nuclear power, produce all this stuff, and then use it to produce other more higher valued goods and then sell those. There's just no way around it. You're not going to be able to, at one hand, try to increase production of things so that you could be self-sustaining, right? And you're going to create this supply chain for your own domestic economy while trying to force foreigners to also buy from you at the same time. So you're having this double whammy. It's like the Trump administration is shining a light on this problem of the twin deficits, and they're angry about it, and they're blaming the rest of the world for ripping them off. But in the process, they're going to force the rest of the world to actually look at the relationship and go, well, wait a second here. Who's ripping off who? And so why have I been accumulating all these dollars? This makes no sense. And how could I possibly spend them in the USA? What am I going to get for it? And then you start realizing, wow, I'm loading all this stuff on the ships and I'm sending you all this stuff and I'm accumulating dollars. And the only way it makes sense is if I spend those dollars, like Canadians selling cheap oil to the USA and then turning around and taking those proceeds and buying cheaper goods from China. It's a good trade for us. We're like, yeah, here's some cheap oil, but shit, look at what we're getting. We're getting this really cheap stuff from China. And this money just keeps flowing from country to country down. But if the USA is going to shut that door and say, no more, we want you to buy, it becomes a totally different proposition. People are going to be like, well, look, this doesn't work for us. Settling up trade today, where we're going to just start overpaying for a massive amount of goods in order to sell you this stuff cheap. It's just too in your face, you know? It's like shining a spotlight on the ridiculousness of the current system. The conclusion I believe that people are going to draw, right? Whether it's central banks, corporations, individuals, is the US dollar is going to have to fall. In this world that we're trying to project forward of balancing trade, it seems to me, and I think it's going to seem more and more to the rest of the world, like, well, I'm not paying those prices. It's not worth it for me to buy, XYZ from you when I could buy it so much cheaper from the rest of the world. So the only way we're going to settle this trade up, if the USA is going to kick up a fuss and demand that the trade get settled, it's going to result in a drop in the US dollar, and it depreciates everybody's purchasing power. All savers, anyone who's accumulated cash or bonds, their savings gets depreciated. Inflation is coming to America as a result of trying to close this trade deficit. Any way you slice it, the combination of the twin deficits of the budget deficit and the trade deficit is very inflationary. And the inflation has been understated for years because of a willingness of foreign holders to accumulate $8 trillion of debt. Foreigners are becoming increasingly concerned about holding that $8 trillion of bonds. It's like that dam breaking, right? You've got all this potential buying power, right? All these bonds, all this cash behind the reservoir, right? Piled up in the banking system with no claim on anything. And if individuals start, water starts lipping over that dam, they open up the floodgates, start buying things, right? Going, well, I'm not going to hold bonds, I'm going to hold gold, I'm going to hold silver. Well, if you see silver ripping every day, you see gold ripping every day, your desire to hold bonds becomes less and less. And the price action causes more people to want to exit. Today, there is, again, in my mind, another massive promise that is being broken, and it is going to become more and more obvious to people. People don't see it yet as a broken promise as much as they should. And this is the printing of money to monetize debts. The only way that the promise of value is kept is through taxation. I don't trust the U.S. taxpayer to vote for taxes. I trust them to vote for tax cuts. I trust them, based on history, to give everyone the finger. Right? You're forcing people to start consuming that have traditionally been saving. And that is going to unleash an unholy hell of inflation on the average American. That's what I see coming. And again, this isn't investment advice. This is just this is just entertainment purposes, right? So you can't sue me for it. But I'm saying this for, it's funny that we have to say that, like all these different podcasts, and myself will say it, it's for entertainment purposes, and it's just my opinion, and you should get your own financial advice. But what I'm talking about here is trying to make a decision. I'm trying to share with you what I see, how I'm positioning myself, what conclusions I've come to. And I'm of the belief that fiat currency is garbage, that taxes aren't going to be paid, that deficits are going to be printed away, that the printing press is going to be fired up again, and that savings, people who have put their savings in bonds, are going to be hurt seriously, like seriously hurt, especially foreigners who are holding $8 trillion of U.S. government bonds. They're not going to be able to buy $8 trillion worth of stuff in today's prices, okay? That's not happening, right? If you force them to spend that $8 trillion of savings, the price of everything would double, triple, and quadruple, and they'd probably buy maybe $2 trillion worth of goods. One of the things we're going to keep talking about with Energetic Media and the different podcasts that we do is going to be about patterns, about pattern recognition. The world is slowly but surely recognizing a certain pattern here, which is Y2K, the markets blew up, the banks started to get into trouble. What did we see? Money printing, cutting of rates, big surge in government spending to try to offset the decline in the economy. 2008, another correction, problems in the credit markets, problems in the equity markets, massive printing, cutting of rates, the adoption of quantitative easing. And then we had this huge rebound in this bull market in stocks that ensued because of this massive quantitative easing and this printing of money that really kicked off in 2008. And then when COVID hit and the lockdowns came, and again, everyone was worried about what's going to happen, credit crunch, stock market collapse, well, Fed to the rescue again, this time trillions of dollars being printed, quantitative easing on steroids, massive infrastructure spending, deficit spending, creation of money flowing to the banks, bailouts, you name it. Off we go again, another rip-roaring surge in the markets and the bond markets. The bond markets, we had historic low yields during that time as the money was being printed. And ever since then, we've seen that when the Fed reduces liquidity, right? When quantitative easing stops, when they start trying to reduce the balance sheet at the Federal Reserve, we see bond yields rise, and it starts hurting stocks too. And so what, if anything now, the new pattern that everyone's identifying is that both stocks and bonds are correlated to each other, and they're correlated to central bank printing. They both need quantitative easing to survive. And so I think it makes sense, or at least my opinion is you got to front run this trade. You need to get out of bonds and cash and hold on to something real. And when I look at things that I think are real that you could hold on to, I go back to the history that silver and gold has had. There has been a serious erosion in faith in the US dollar over the last 25 years, right? Since around the year 2000 is my mind, when it really started to accelerate. And that's when gold went from 300 to now 3,000, right? It's over 3,000 or 3,300, I think, today. Right? So that's an 11-fold increase. So this erosion of the US dollar as being a store of value is fairly clear and apparent to everybody. But it's still, we're still scratching the surface. And that we expect, and that maybe not just that we expect, that we're going to be right in predicting that, yeah, it's going to go up by another tenfold over the next, it'll be $30,000. And whether it's 10 years from now or 20 years from now, gold will be at $30,000. And silver will be at maybe $2,000, right? And these relationships that we see, these natural relationships, like the 15-to-1 relationship between gold and silver, will come back to play. I get it. Tons of people will say, oh, you're crazy. He's talking $30,000 gold, right? Well, people said I was crazy when I was talking $3,000 gold 20 years ago, right? Or 25 years ago. But that's where we're headed. We're headed to those numbers. And obviously, the tough part is trying to predict when everybody wakes up and says, let me out of these bonds, right? Let me out. And you don't want, all I know is you don't want to be the last guy out. The reason I call the company Energetic Media and I called my upcoming book The Energetic Investor is because everything comes down to energy at the end of the day. And it's about having the energy in your body and your mind in order to be able to focus on what you need to focus on, to be able to dig into things, do the analysis, and make the right decisions to protect yourself financially and to protect and plan for your future. Thanks for tuning in. Please like and subscribe. I'll see you next week.